Good morning, everybody. Welcome to the session. My name is Joe with MoneyShow, and I'll be your moderator this morning. Thank you for joining us on day one of the Accredited Investor Virtual Expo. We're happy to have you here. Two bits of housekeeping. We're going to get right into Tom's presentation. First and foremost, we want to thank everybody who participates in these sessions. We appreciate you. Keep your comments, feedback, suggestions coming to us here at MoneyShow. It helps us refine our process and get better and better. There is a chat box that's on your desktop during Tom's presentation right now. He has a hard stop at 10 a.m., so we're going to get right into it. If you have questions during Tom's presentation, there is a chat box on your desktop. Shoot those over. We'll get to as many at the end of his presentation, time permitting. With that said, it is my great pleasure to introduce to everybody Thomas Lee. Thomas is a managing partner and the head of research at Fundstrat Global Advisors. He is an accomplished Wall Street strategist with over 25 years of experience in equity research and has been top ranked by Institutional Investor every year since 1998. Prior to co-founding Fundstrat, he served most recently as JP Morgan's chief equity strategist from 2007 to 2014, and previously as managing director at Solomon Smith Barney. His areas of expertise includes market strategy, small mid-cap strategy, and telecom services. It is my great pleasure to introduce to everybody Tom Lee from Fundstrat. Tom, thank you very much, sir. The floor is now yours.
Hi, welcome everybody. I'm gonna speak for the next 18 minutes and then set aside 10 minutes for Q&A. What I hope to cover in that time is a few things. You know, number one is just talk about markets into year end you know, where we see things. You know, so far it's a textbook year. The second is talk about why we're still constructive on stocks and much more than just a short-term window. And it has a lot to do with just really three simple things. One, I think the economy is rebounding in a way that's difficult for a lot of cycle analysts to understand because, you know, we're coming out of a depression, but it's leading to, I think, the potential for substantial profit margin expansion. And then there's a demographic tailwind. Hopefully I can talk about some themes for 2022, but, you know, it's a bit early and I'm gonna, you know, do that formally in December for our clients of FS Insight. So, you know, you're not gonna hear too many hints about next year, but really it doesn't matter because, you know, the real window right now is between now and year end. So let me dive into this presentation and let's just start with what we thought 2022 would look like. Okay, 2021, sorry. So at the start of 2021, we essentially had five sort of pillars to sort of our view on the markets. One was that we thought this would be a year of profit cycle reversion, which meant instead of a collapse in profits, we've had a recovery. We'd see an investment cycle reversion, so a inventory cycle, a housing cycle, and a CapEx cycle. And part of that's happened. Actually hasn't been fully realized. And I think a lot of that carries over into next year. We thought there'd be a volatility reversion. You know, we had an extremely high volatility year in 2020. And historically, years that have high volatility are followed by low vol regimes, which is 2021. And the average gain is typically 25%. And year to date, the S&P is up 25%. So we're pretty much a textbook year just on this metric alone. We just think that this was also potentially a reversal point for the value growth trade. And I think this only partially played out so far. So I think that this is still a multi-year story. And then I think, you know, we thought 2021 would be a year where, you know, you'd start to see rotation of bonds into stocks. And indeed that's happened because, you know, stocks are handily beating bonds by a huge margin this year. Okay, so where does that lead us? Well, you know, we have been using a template, which is we've been taking the 12 years where the market had the first half gains of double digits. And that's the gray line here, okay? So this gray line is the historical average of those 12 years. And this blue line is 2021. And here's the interesting coincidence. It has so far been a textbook year. Like literally, if we pick today's date, we're tracking exactly what the composite should say we have. And like you could see, there's this consolidation, we had the consolidation. So this year is playing out really textbook. But here's what's interesting. What does it say about year end? it says we should be up 28%. Okay, which means we still have a lot of upside, and the S&P should be 4850. So that's actually our base case, that, you know, even though the S&P is at 4,700 right now, we just think into year end, there's still quite a lot of upside. So I wouldn't be giving up on stocks here into year end. And I know people are cautious, but I think it's too early. Now, why do we think stocks can still do well in the next few months? Well, first of all, I just think there's still a lot of pent up demand, and these aren't fixed. You know, they haven't been fixed by just 1 year of expansion. You know, there's a lot of pent up savings here, potential spending. There's still a huge lag in manufacturing, which means there's still an inventory cycle ahead. Look at the sales versus inventory gap here, which means, again, stocking. And then CapEx intentions are up. So this is all signs still of an early expansion. And when it comes to equities, which is what matters most to all of us here, I think 2020's biggest takeaway was the unkillability of the corporate blue chip in America. We had a depression, a seizure of the economy, a complete shutdown, things that you wouldn't happen in 5 lifetimes. And normally you would say, before 2020, you'd say, look, if we had a depression, shut the economy down, most companies in the S&P would go bankrupt. And instead, companies didn't go bankrupt, which means I think these companies are a lot more resilient than people realized. And in the meantime, during the shutdown, they cut costs dramatically. And what does that tell us? Well, one, look at the earnings revisions. This is the path of earnings expectations at the start of every quarter, okay? And fourth quarter 2020, which was a year ago, you can see earnings revisions were 15% above consensus. Now we're in third quarter 2021, 4 quarters later, and earnings are still being revised higher. I mean, this is showing you Wall Street still has underestimated by a huge margin the profit recovery taking place in corporate America. And you can see that if you look at the epicenter groups here, okay, the biggest revisions have been energy and financials. These are the tip of the spear. And energy is a great example because this is an industry people thought was fundamentally a bad industry, but still 4 quarters into this recovery, energy companies are beating earnings by an average of 18%. Huge operating leverage taking place. And what does that mean in a bigger picture? Well, if you look at profit margins since 2000, okay, this is where we were in 2000. And you can see at every expansion or profit recovery cycle, you have some margin expansion, but we started here in the basement. And a lot of skeptics would say this is the trend line. Well, actually, we think what's going to happen is that profit margins are going to hit an all-time high. And that's because companies cut costs dramatically. And by cutting costs, operating as if they had just emerged from a crisis, and now, okay, with supply chain glitches, this is really setting the stage for profits to surprise even into 2022. Now, you might say, well, isn't the economy overheated? And my answer is no, not yet, because utilization is really what causes inflation, okay? Both usage of assets and labor. So the top chart is capacity utilization. And you can see that we're at 75%. But if you draw a line, 75% is normally what you see in a recession, okay? We're not even at a level of capacity utilization that usually marks a peak in the cycle. And in fact, the only time you really had inflation generated by asset utilization was when manufacturing was tight in the 70s and 80s, and that was when utilization was over 80%. Similarly, if you look at labor utilization, which is the number of people working to population ratio, we're at 59% labor utilization ratio. And in the 90s and the 2000s, this was a tighter market when you were in the 60% range. So, I mean, if I would eyeball this, basically we're at the same labor utilization rate as 2014. And as you know, nobody was really talking about inflation in 2014. So I know that there are people reluctant to go back to work because of COVID, and that's creating imbalances, but that's really different than an oversupplied labor market, or sorry, an overly tight labor market that's causing inflation. And in terms of inventory, because that's another reason you get a cycle peak, this is total retail inventories, and you can see it's been falling since 2020. And in fact, this is the quarterly change. You can see that these are periods of destocking, which happened during a recession, and inventory is still being destocked today. So I don't think we're even mid-cycle in the economy. And if you're mid-cycle, you don't want to be exiting stocks because it's still early. Now, in terms of interest rates, I think it's still hard to predict the path, but I do think in general, this is the light blue line. I think it's hard for interest rates to make new lows. So let's say that I think, interest rates do this and maybe potentially start to creep up. The dark blue line is the value versus growth relative performance. So when it's rising, value's leading. And you can see when interest rates are rising, value stocks lead, like here and here. So if interest rates are starting to curl upwards, I do think that this is going to lead to value stocks outperforming growth. And that's something we're watching for. And this just means asset-based companies do better. I think negative interest rates, real rates, is also something we have to keep in mind. And what that means is CPI, which is the light blue line, will be higher than the nominal level of interest rates. And so you get a negative spread, okay? And you might say, Tom, there's no way interest rates can be negative. Well, it turns out, number one, that was the case in Japan for nearly 10 years and for Europe for the last 10 years. So the US is the only region without negative real rates, major region. And in fact, if you look at history, you can see that this is the 10-year since 1880, and the red line is CPI. You can see that there have been 3 other periods where we've gone through an epic or roughly a decade of negative real rates. And this is actually quite good for stocks. Why is it good for stocks? Because companies' top line growth and therefore profits are driven by inflation or CPI, but their cost of borrowing or cost of capital is the 10-year. So if you have a negative spread, that means they're earning extraordinary profits. And in fact, this is what you've seen, that this is the 10-year, bottom chart is 10-year rolling return of the S&P. During periods of negative real rates, S&P performance is parabolic. So I think if we're talking about negative real rates here, S&P probably goes parabolic here. And this is the final section I'm going to cover really quick so I can open a Q&A, which is there's a demographic reason I think we're going to go parabolic, which is it's the millennials. This is the 6 living generations in the US, and it's roughly separated by 20-year intervals. And I listed here the year each generation peaked in total size. That's the year that the number of people in that generation is the highest. It's not the year of birth because of immigration. It's actually the highest number is when they're roughly in their 40s. And so you can see this greatest generation peaked in 1930, silent generation peaked in 74, baby boomers peaked in 99, Gen X peaked in 2018, and millennials aren't expected to peak until 2038. So why do these years matter? Well, take a look here. This is the Dow since 1900. And I put vertical lines for every generation peak. You can see every peak in the generation marked a major market top. And Generation X peaked in 2018. And what has happened since? Well, we've had 2 major market drawdowns, a 20% drawdown and a 40% drawdown. So the point of this is that if this indeed is playing out again, we are now in the midst of the in-between period. And you can see in every in-between period, S&P returns are extraordinarily good. So I think that this is the rough path through 2038. Now, why is this happening? Well, the most important cohort is people aged 30 to 48 in an economy. And you might say, Tom, I don't understand why this matters. Well, just follow this logic for a moment. But the peak income years, the peak productivity of a person's life is when they're between age 30 and 48. And so in theory, the economy should do the best when there's a lot of people aged 30 to 48. And you can see here, this number is actually quite cyclical. And it actually peaked here with the boomers. And because of Gen X, it started to turn down. In fact, it went negative beginning in 2003 and bottomed in '08. And what happened in that period of time? Well, we know that this is when the economy actually lost its resilience, and now it's turning up, starting with millennials, and turned positive in 2016, and looks like it'll continue through 2035. So we actually have still 15 more years of this as a tailwind. Now you might ask, Tom, why does the number of people, again, age 30, 50 matter? Well, take a look at this chart. These are the major blue chips today: Apple, Costco, Home Depot, Blackstone, Bloomberg, United Health, Cisco. I mean, just a handful of companies. And look at when these companies, the age of the founders when they were created. Every one of these companies was founded by somebody in their 30s. Okay, so what does that mean? Well, if the best companies are created by people in their 30s, then the best cycle of innovation takes place when there's a lot of people age 30. That's what this chart's saying. Look, greatest generation that surge, 50s. That was the big industrial revolution, right? Look at this, the boomers, all the way through the 80s to 90s. What happened? We had a huge innovation cycle here. And Gen X obviously is shrinking, so we haven't had a lot of great new companies. But look, now the millennials are surging. That means we are in a period of, I think, of structural innovation. That's kind of what Kathy Wood is talking about with the age of exponential growth, and I would tend to agree. So, well, why does that matter? You can see millennials are going to be huge. I got to brush through this really quick. But here's what it means for the stock market. Here's the number of age 30, 50, and below is the rolling 10-year return of the S&P. It tracks us identically, and this is implying the S&P could reach 20,000 by 2029. So again, I think we're in a long-term bull market. Okay, thematically, bet on a generational bet. The boomers liked consumer stocks, they went parabolic. Gen X liked internet, they went parabolic. What do millennials like? They like crypto. So I think crypto, because it's really the center of digital assets meets finance, or tech meets finance. I just think crypto, and that includes Bitcoin, is a really important theme over the next 10 years. And, in terms of equity sectors, these are our themes. I'm going to run through this real quick. In 2021, we had these 5 themes. Supply chain moves back to the US. We're already seeing that. De-urbanization, we're seeing that. Work from home, we're already seeing it. Buy America, we're already seeing that, especially with supply chain. And violence in America. I think a lot of this is going to shift next year. But from a sector perspective, we like FANG. Well, number one, we like energy because there's structural shortage. We like FANG. In fact, I think next year FANG has an even better year. So I think FANG is a structural long. And this one, basic materials are starting to break out. We like them. It's been a tougher trade, but it's starting to work. And again, we like that into year end. But as you can see, we pretty much like epicenter. And with that, I'm going to just stop it here so we have time for questions.
Tom, thank you very much for your insights. We got a bunch of questions. We'll get to a few of them because we have a 10 a.m. hard stop for you. Rashmi is asking, as investors, Tom, we want to avoid big drawdowns. In your opinion, what are the signs that we should be looking for to protect from any big drawdowns in the future?
Actually, that's a great question, and it's important because you have to make sure you're preparing yourself properly. I think the mistake most people make is that if they think there's a drawdown, they liquidate their portfolio and go to cash. Okay, and MIT did a study, and they found that there's an increasing probability that Americans are liquidating their portfolios and going to cash. Partly because trading has become frictionless, so people can sell with a push of a button. But it's also, it turns out that it's generally people over age 45 that are 45 that are male. So basically, men over 45 are the ones that tend to panic and sell all their stocks. A drawdown, people worry about losing capital, but that's not how you invest. I know people trading, that's what traders do, right? Traders got to protect capital. Investors don't investors put capital to work to earn the best probability of a reward in a future date. I mean, that is literally the basis for investing. And 2020 is a great example. I know so many people that said they were geniuses because they liquidated their accounts in April or May because the market was down 20, but they avoided the next 10% loss. And they never got back in. And they still probably didn't recover to 2019 levels. That is an example of why you should never manage your portfolio for drawdowns. I think you should manage it for long-term gains. And that means buy the best things. And so my advice is, if you think there's a drawdown, then you don't put new capital to work. Do you liquidate your portfolio? I've never seen it work. I got to tell you, I mean, how many people do you know that are rich because they time the market? I mean, I want you to be honest. How many people that you consider great investors made durable, sustained fortunes because they timed the stock market? I think time in the market is the only way you make money in the equity market. And I just think don't trade for drawdowns.
Thank you, Tom. Brian's asking, your scenario sounds pretty bullish, Tom. Do you see any scenarios, for example, inflation, Fed tightening, that could derail a bull thesis?
Yes. I mean, number one, if you really want to keep track of our real-time thoughts on markets, including what we think are probabilities of softness, because, this year we advised our clients several times about the risk of chop, and people did get chopped up this year. And you really should, look at FS Insight. And I'm not saying to advertise. I just think Twitter's great and whatever, and CNBC, but you're never going to really understand the thesis. And people panic sell. Like I said, people panic sell at the wrong times, and they get out of things, and then they leave a lot of money on the table. I mean, Bitcoin's a great example. How many times people liquidated their holdings, and I mean, Bitcoin's almost a 10x in the past 18 months. I guess yeah, sorry, what was the question? Sorry, because I'm
bull thesis. Like, what are your thoughts in terms of
there's a lot of things that can go wrong.
Right. There's a lot of factors, right?
Yeah. I mean, I'm just telling you, I'm not like blindly buying stocks here. A lot can go wrong, because remember, if the market loses confidence in the Fed, the stock market's in huge trouble. The whole financial system's in trouble. If inflation expectations aren't anchored, we're in big trouble. If the supply chain glitches are permanent, then there's definitely winners and losers. I mean, big time winners and losers on the supply chain. And so you can't say everything wins. And COVID is still not gone. I mean, COVID could come back roaring back. And if it does, I mean, I don't think it is. I mean, but that's just my opinion. My opinion doesn't matter. I mean, that's another thing. Like, I know you a lot of people care about what we say, and we're an evidence-based research shop, but as you know, the stock market doesn't care for anybody's opinion, and we really need to just listen to the market. That's what most of our day is spent doing. As at Fundstrat and FS Insight, we try to see what message is coming out of the market. So I know it sounds a little backwards, but I guess my answer is, I mean, a lot of things could go wrong.
Right. And folks, I'm being as objective as I can here, but if FS Fundstrat should be part of your investment process, I will say it, Tom won't say it. And we have to be objective here at MoneyShow, but definitely it should be part of your process because it's great info. Tom, what are your thoughts? You mentioned energy as your number 3 pick, maybe for next year behind FANG and materials, I think. Any thoughts on energy, oil, for example, next year in 2022?
No, I think people need to exercise patience with energy, okay? Because this is not going to be a straight line progress sector. But if you ask me what sector can do nearly as well as, like, what's the most undiscovered sector, I think it's energy right now. Because number one, most people aren't acknowledging there is a structural shortage of oil. There's oil in the ground, but it's difficult to get because no one's financing it. And the U.S. policies making it impossible essentially to get more oil. But in the meantime, people are consuming a lot more oil. So you got a structural shortage. That's going to take years to fix. I mean, we're talking years. Second, people don't own energy stocks because they think they're bad businesses. But as I showed you, they had the best earnings revision. But this is no different than how people treated home builders and financials after the GFC. Don't you remember the GFC? And everyone said, I'm not touching home builders. I'm not touching the banks. Guess what sectors just destroyed the S&P? Massive outperformers in that period of time. It was home builders and financials. Energy is the most reviled and maligned sector. And look at home builders and financials between 2010 and 2015. They had a jagged recovery, really jagged, but then they went ballistic. And I think we're still in the jagged phase for energy. So I think XLE, OIH, XOP as ETFs are great investments right now. And you just don't want to lose your patience, because if you think oil, look, White House is trying to trash oil this week. It went down $1. I mean, like, there's just not enough oil out there. I mean, oil could go to 150, and it's still not going to hurt the economy. I know people don't want to pay that for gasoline, but $150 oil today is like $200 oil in 2008. I mean, wow. Oil could go a lot higher, and it's still not going to hit the economy.
Tom, any thoughts on, you mentioned the supply, the glut, transportation, the index had a bounce off that 14,000 level, had a huge bounce over the last couple of weeks. Any thoughts there? Maybe not technically speaking of the transport index itself, but transportation in general. What are your thoughts?
If anything, the transports, you got to believe the signal coming from this massive transport outperformance, okay? Because like someone will say, oh, it's just because of Avis. That's not right. The transports are up 35% year to date, okay? And the Dow is up 18. Why? It just shows you this economy, which even though everyone says it's digital and there's no assets, that's wrong. It involves the movement of goods, and that has become a lot more important and exposed today. So the transport sector is re-rating because the people's understanding of the economy is changing. And whether it's the rails or the trucking, these are really good businesses. I know some trucking analysts because of my days at Kidder and Solomon Brothers, and these guys are just saying it's a structurally better industry. And by the way, if transports are doing this, I'm just telling you, energy's going to do this. I mean, you got to just stop trading and thinking you got to make money every day. You got to go for the bigger pivots. And so transport's real signal.
Well, I appreciate your insights. I'm going to leave you at a 10 a.m. hard stop. I know you got something coming up after. We had a great crowd in this room. There were a lot of questions. We couldn't get to them all, folks. Thank you for sending those over. I did put Tom's email in the chat box, thomas@fundstrat.com. Get with him and his team. Take a look at his research, of course. Make it part of your process. Tom, we want to thank you from Money Show from the bottom of our hearts for your insights and your time this morning. Phenomenal, and we appreciate you. And folks, thank you for all your participation in these events. We're going to be back live in February, the 24th, 25th, and 26th Money Show Traders Expo in Las Vegas. Tom, I think you'll be joining us, so we'll look forward to seeing you there. You were with us in Orlando last year.
Doing this. Yeah,
it's great. We love having you, and obviously your insights are extremely valued by our entire audience. So we look forward to seeing you there, folks. Thank you very much for joining the session with Tom Lee, and we hope you have a great rest of your session today. Tom, you, my friend, have a great day, and we will see you soon.
Thanks, you too.
Thanks again,
take care,
everybody.
everybody.
Have a great day. Bye-bye.